Have you ever stopped to think about, well, the inner workings of massive corporations? I mean, those huge groups with a parent company and, dozens of subsidiaries, maybe all over the
Uh,
place. How do they actually charge each other for things, for services? And why does that, internal bookkeeping actually matter so much for something like VAT, value added tax?
right. It seems like internal admin, but it's huge.
Exactly. It's this whole world of complexity, hidden costs, and some really crucial legal fights.
Fights that really shape how business gets done across Europe.
Totally. And today, we're diving deep into exactly that hidden world. We're going to dissect a brand new, pretty highly anticipated judgment from the European Court of Justice. It just came out this month, July 3rd, 2025.
Very fresh, yes.
And this isn't just, another dry ruling. It's a decision that sets a really powerful precedent for how services, specifically those from a parent company to its subsidiaries, are treated for VAT, right across the whole EU.
It's a big one.
So our mission today is pretty clear. We're here to unpack this ruling, really get into the details. We'll focus on the specific Swedish case, Högkullen AB versus the Swedish tax agency.
It's our favorite cat.
We'll try to cut through the legal jargon, pinpoint the surprising bits, the nuances, and help you understand exactly why this decision is such a big deal for both the companies and the tax authorities.
It's essential info for anyone dealing with group structures.
Think of this as your shortcut, your way to get properly informed on something that usually stays behind closed doors. But the stakes are incredibly high.
Definitely.
And it's not just about tax law in the abstract, is it? It's about that tricky balance between, stopping tax evasion, which is fair enough,
A legitimate concern.
but also letting businesses actually operate efficiently, fairly.
Right.
So get ready for maybe a few aha moments as we shine a light on how the EU defines value inside these huge corporate families.
Okay, sounds good. Where do we start?
All right, so to really set the stage for Högkullen, we need to nail down some basics first. Now, many of you listening will know VAT. You know the system's designed to be neutral, right? The tax hits the final consumer, not the businesses along the way.
That's the theory. Input VA deduction is key.
Exactly. But what happens when that supply chain is all internal, like within one company group? That's where this idea of open market value suddenly gets, really complicated.
It really does, because, as you said, VAT is fundamentally a general consumption tax. It should be proportional to the price, applied at each step. Businesses collect it, but they deduct the VAT they paid on their input.
Their input VAT.
Exactly. So it should pass through businesses neutrally, and the final consumer bears the burden. That's critical across the EU. Avoiding distorted competition, making sure goods and services flow smoothly.
And smack bang in the middle of this, especially when you've got related companies trading, is this term open market value. Sounds simple, right? What would you pay for it out in the real world?
Yeah, sounds straightforward.
But does that simplicity hold up when it's, say, parent co. selling to subsidiary LTD? What makes it so complex there?
Well, that's precisely where it becomes a kind of battleground. The whole point of the open market value concept, looking at the big picture, is to stop tax evasion or avoidance.
Ah, okay.
Imagine a parent company selling a service to its subsidiary for, I don't know, €1, just a nominal amount, way below what anyone else would pay.
Right, to artificially lower the VAT bill?
Exactly. That's what the open market value rule is there to stop. It's about fairness, stopping artificial manipulation of the tax base, and making sure these internal deals don't mess up the whole VAT system.
So where does the law actually define this?
It's in the EU VAT Directive, specifically Article 72, and it's got this two-pronged approach, which is really what caused all the friction in the Högkullen case.
Two prongs, okay.
Yeah. The first paragraph, that's like the gold standard. It says open market value is the full amount an independent customer would pay to an independent supplier. Fair competition, arm's length, that's what you want to use. A direct market comparison.
Because it reflects reality.
It reflects economic reality, exactly. But then, and this is the crucial bit, the second paragraph gives an alternative. It says, if you can't find a comparable supply, if there's no market equivalent out there.
Which might happen with some specialized internal services.
Precisely. Then, for services, the open market value is defined as an amount that is not less than the full cost to the taxable person of providing the service.
Ah, the cost method.
That's the fallback, the safety net for tax authorities when they say, look, we can't compare this to anything. And the whole Högkullen fight and the ECJ ruling really hangs on which of these applies. And crucially, when you decide you can't use the first one, How do you value something that maybe doesn't have an obvious market price because it only exists inside this closed corporate loop?
Okay, that sets the scene perfectly. So, with that foundation, let's zoom in on Högkullen itself. This is where it gets really interesting, right? Started back in 2016, Swedish real estate group. Tell
Yeah.
us about their setup.
Right. Högkullen AB, they were the parent company in a group focused on real estate. Their main job, the raison d'etre, really, was actively managing their subsidiaries. And these subsidiaries were doing the actual real estate business stuff.
Okay.
So Högkullen provided a whole bunch of services to make that happen. It wasn't just one thing. It was a pretty wide range. You had core business management, strategy stuff, financial services, think treasury, helping with loans between companies,
Makes sense.
specific real estate management advice, investment services, helping buy and sell properties, plus essential IT support, infrastructure, and even staff admin, like HR stuff for the group. A whole package, really.
So, quite comprehensive, and they charged for this.
They did. For the 2016 tax year, they charged their subsidiaries about SEK 2.3 million total. That's roughly EUR 204,000 back then. And crucially, they charged VAT on that amount. They saw these as taxable services.
Okay, and how did they get to that 2.3 million figure? Was it just plucked out of the air, or was there a method?
No, definitely a method. They use something called a cost-plus approach, which is pretty standard for these internal group charges.
Right, I've heard of that. Cost plus a markup.
Exactly. They figured out the direct costs of providing those services, salaries for the managers involved, maybe specific IT system costs used by the subs, professional fees linked directly to those services. Then they added a profit margin on top.
Standard practice.
Pretty standard. Now, figuring out which costs were actually service-related involved using an allocation key. This was for the general overhead, shared offices, phones, the main IT network, even things like corporate hospitality, travel for the parent company management. If a cost supported both the parent's own existence and the services to subsidiaries, they split it using this key.
Okay, trying to be fair about allocating overheads.
Trying to be fair. But, and this is absolutely critical, it became a huge sticking point. Högkullen excluded certain costs from this calculation entirely.
Excluded.
Which ones? They called them shareholder costs.
Yeah.
These were things like the cost of drawing up the parent company's own annual accounts, the external audit fees for the parent, costs for their own general meetings, expenses for raising capital, planning share issues, stock exchange listing fees.
Things related to just being the parent company, the owner.
That was their argument. Exactly. They said these costs are for the benefit of the parent as a shareholder, not for providing services to the subsidiaries. They're the cost of ownership, not the cost of service provision. A fundamental distinction in their eyes.
So the tax authority basically looked at this and said, hang on, every single penny Högkullen spends from, the CEO's coffee to the big audit fees that all counts as part of the cost of this management service. That sounds quite extreme. What kind of money are we talking about here?
It was definitely leaning towards the finance director's nightmare scenario. Just to give you a sense of scale, Högkullen's total costs in 2016 were around SEK 28 million. That's about EUR 2.5 million.
Okay, much bigger than the 2.3 million they charge.
Much bigger. Roughly half of that, about SEK 14 million, were costs subject to VAT. The rest were things like wages or VAT-exempt costs. And here's another key detail. Högkullen deducted the input VAT on all its costs where VAT was charged, including the input VAT on those shareholder costs they'd excluded from the service charge calculation. So they got the VAT back on those shareholder costs, even though they didn't charge VAT on them to the subsidiaries via the service fee.
Precisely. And that full deduction, combined with excluding those costs from the service charge, is really important for understanding the overall VA picture and why the tax authority got interested.
And this is exactly where Skatteverket, the Swedish tax authority, stepped in. They just fundamentally disagreed with how Högkullen valued these services. What was their main line of attack? Exactly. Skatteverket came in strong. They argued that the price Högkullen charged at SEK 2.3 million was lower than the open market value. And their core argument directly invoked that second paragraph of Article 72 we talked about.
The fallback rule.
The fallback rule. They claimed there were simply no comparable services available on the open market, not for the kind of active, integrated, hands-on management Högkullen was providing specifically to its own subsidiaries.
So they're saying it's unique, uncomparable.
Unique, uncomparable. They argued Högkullen's role was so intertwined, so specific to that group, that you couldn't benchmark it against anything an independent company might buy or sell. It was sui generis, essentially.
Okay.
And because they claimed there was no market comparison possible, they triggered the fallback rule. They decided the taxable amount for VAT should be Högkullen's total cost for 2016.
Wow. Including everything.
Including everything. Yeah. All those shareholders' costs, the accounts, the audits, the capital raising that Högkullen had carefully excluded. The tax authority basically said, look, if we can't find a market price and we think this is one unique package deal, then your entire cost base is the taxable amount. We don't care about your internal allocations.
And that obviously meant a much, much bigger VAT bill for Högkullen.
Substantially bigger, yes.
So this wasn't just a minor disagreement. It went all the way up through the Swedish courts and eventually landed at the ECJ's door. Can you trace that legal path for us? What were the courts arguing about?
It definitely climbed the ladder. So the tax authority's initial decision was challenged, and it first went to the Administrative Court of Appeal in Gothenburg. Back in March 2021, that court actually sided with the tax authority.
Oh, really? So Högkullen lost the first round.
They did. The court upheld the decision to revalue the taxable amount using the total cost method.
Okay.
Högkullen, obviously not happy, appealed again, this time to the Högsta Förvaltningsdomstolen, that's the Supreme Administrative Court in Sweden.
The top court.
The COP court. And they looked at it and clearly saw the fundamental EU law questions tangled up in this. They realized this wasn't just about Swedish rules, it was about interpreting the EU VAT directive.
So they decided to ask Luxembourg.
Exactly. They acted as the referring court.
Mm-hmm.
They paused their own case and sent questions off to the European Court of Justice for what's called a preliminary ruling. It's a vital mechanism, ensures the VAT directive is applied consistently everywhere in the EU.
And the core fight that led them to ask the ECJ was?
It boiled down to this fundamental clash.
Yeah.
Högkullen was adamant that its various services, IT, finance, admin, etc., should be looked at individually. And they argued you can find market equivalents for each of those if you look hard enough. You can buy IT support, you can outsource finance.
Right, they're separable services.
That was their stance. The tax authority, on the other hand, stuck to their guns. No, this is active management. It's a single, joined-up, indivisible service. You can't just pick it apart. And because it was single and unique, they argued, it had no market equivalent, therefore justifying their total cost approach, including those shareholder costs.
Single, indivisible bundle versus collection of distinct services. That's the heart of it.
That's the crux of the matter right there. And that's what the ECJ had to grapple with.
So when the ECJ looks at this, they're not just deciding for Högkullen. They're interpreting the actual EU law, the VAT Directive Articles that govern these situations. Let's maybe revisit those specific articles again, see what the judges were really weighing up.
Absolutely. Understanding the legal tools they used is key. First, you've got Article 1, 2, that's the bedrock principle. VAT, general tax on consumption, exactly proportional to the price applied at each stage, net of input VAT.
Proportionality and neutrality?
Key concepts. It shouldn't distort competition. It should hit the final consumer. If internal prices are skewed, that proportionality principle gets undermined.
Okay. Then the big one, Article 72.
Article 72. Defining open market value. And remember those two paragraphs, that duality.
Right. Paragraph 1 is the gold standard.
Paragraph 1, what an independent buyer pays an independent seller. Arm's length, fair competition, direct market comparison. That's the ideal. Reflects economic reality.
And paragraph 2.
Paragraph 2, the fallback. If you can't find a comparable supply, then for services, it's not less than the full cost to the provider, the cost-based method. The Swedish tax authority's preferred route here. The very existence of these two shows the challenge with valuing maybe unique internal services.
Okay, got it. What else?
Then Article 73. That's the general rule for the taxable amount. Basically says it's whatever the supplier gets in return from the customer. The agreed price, essentially.
So normally you just use the price they agreed on.
Normally, yes. Contractual freedom. The agreed price is usually the tax base. You need a specific reason to ignore it.
And that specific reason comes from?
Article 81. That's the crucial exception. It lets member states ditch the agreed price, Article 73, and use the open market value, Article 72, instead. But only to prevent tax evasion or avoidance.
And it's conditional, you said?
Highly conditional.
Okay.
Article 81 lays out 3 conditions. All 3 have to be met.
Okay, what are they?
1, close ties. Family, management, ownership, financial, legal links, like parent subsidiary. In Högkullen, everyone agreed management ties existed, so check 1.
Condition met.
2, the price charged, the consideration must be lower than the open market value. This was the absolute core of the Högkullen fight. It was 2.3 million too low. And how do you even know the open market value?
The big question mark.
The big question mark. 3. The recipient, the subsidiaries here, must not have a full right of deduction of VAT, meaning they can't fully recover the VAT charged to them. In this case, that was also true. The subsidiaries didn't have full deduction rights. So check 3.
Okay, so conditions 1 and 3 were met. It all comes down to condition 2. Was the price lower than open market value? And underpinning that, how do you determine open market value when the tax authority says there is no market comparison?
Exactly. That's the knot the ECJ had to untangle.
Hmm.
And just quickly, these EU Articles 72, 73, 80, they were copied directly into Swedish VAT law, so it was a direct application issue.
Right. So faced with this knot, the Swedish Supreme Administrative Court basically threw up its hands and asked the ECJ for help. They posed 2 really fundamental questions, didn't they? Questions that get right to the heart of valuing these internal group services.
They did. The first question, boiled down, was essentially asking, look, when a parent provides this whole range of active management services to its subs, can tax authorities always, just as a default rule, say that's a single unique service package, and therefore we cannot use the market comparison method from Article 72, paragraph 1?
So challenging that automatic jump to the no comparison possible conclusion.
Precisely. Does the very nature of being an active parent manager automatically make the services incomparable? Does it always force you down the path to the full cost method in paragraph 2? It questions whether bundling services internally automatically strips them of their individual market identity for VAT. Okay, that's a big question. And the second question built on that directly. The second question was, okay, if the answer to question 1 is yes, if it is always treated as a single unique supply, then is it okay under the VAT directive to define the full cost from Article 72, paragraph 2 as all of the parent company's spending, including those shareholder costs, audits, accounts, capital raising meetings that Högkullen argued weren't related to the services to the subs?
So questioning the scope of full cost.
Exactly. Especially when the parent's main or only job is managing subsidiaries, and it's deducting all its input VAT anyway. Can the tax authority just sweep every single cost the parent incurs into the taxable base for those internal services? It was a direct challenge to how far cost of providing the service could be stretched.
Right. And the ECJ, well, they don't just give quick answers. They look at the principles, the history, the case law. Their analysis on this whole single supply versus multiple distinct services idea must have been pretty detailed.
Oh, absolutely. And there's a lot of established ECJ case law on this exact point.
Yeah.
How do you decide if a deal with multiple parts is one thing or many things for VAT?
Mm-hmm.
The starting point, the general rule from Article 1.2, is actually that each transaction should normally be seen as distinct and independent.
Keep things separate unless there's a good reason not to.
Basically, yes.
Yeah.
It helps clarity. However, the court always stresses you need an economic reality check. If a transaction viewed objectively really forms a single supply from an economic point of view, you should not artificially split it up.
Why not?
Because that would distort the VAT system.
Yeah.
You'd end up applying different VAT rules to parts of what is essentially one economic event. The court wants to look past the contracts, past the invoices, to the actual substance of what's being supplied. Especially with group companies who could, creatively structure things.
Okay, so how do they define that single supply in practice? What's the test?
Well, the key phrase is when different elements are so closely linked that they form, objectively, a single indivisible economic supply, which it would be artificial to split.
Objectively indivisible?
Yes. Think about maybe a package holiday. Flights, hotel, maybe some tours. You could buy them all separately, but often they're sold as one thing for one price, serving one overall purpose for the customer, the holiday. The court would likely see that as a single supply. Even though it has multiple components, it would be artificial to split it.
Makes sense.
They also talk about ancillary services. Even if services could be supplied separately, one might be ancillary to a principal supply. An ancillary service isn't an end in itself for the customer. It just makes enjoying the main service better. Maybe mandatory insurance bundled with a flight ticket. You're buying the flight principal. The insurance just facilitates that or protects it. Ancillary. The key is the ancillary part doesn't really have value on its own, only in relation to the main service.
Got it. And what about how the group prices things internally? Does it matter if Högkullen set one big bill or listed everything separately?
That's a really crucial point the ECJ hammered home again.
Yeah.
Whether there's a single price or separate prices contractually agreed has no decisive significance. It doesn't automatically decide if it's one supply or many.
So you can't just change your internal billing to change the VAT outcome.
Exactly. That would open the door to manipulation. The court always looks beyond the paperwork to the economic substance. You couldn't just bundle genuinely different services under one invoice price and magically make them a single supply if, economically, they aren't closely linked or indivisible.
Okay, so applying all that case law, all those principles to Högkullen services, that long list,
Yeah.
management, finance, property, IT, admin, what did the ECJ conclude? Was that a single supply?
This is where the judgment makes its mark. The ECJ looked squarely at that list of services Högkullen provided, and they stated, very clearly, that it cannot be concluded that as a matter of principle, such services are so closely linked that they form, objectively, a single indivisible economic supply and consequently a single supply.
Wow. So a direct rejection of the always single supply idea.
A direct rejection is a powerful statement. Just because a parent provides a range of management services doesn't automatically fuse them into one inseparable lump for VAT. The court is saying these services often do keep their own character. They could, in principle, be provided separately or bought from outside.
And the Advocate General agreed.
Yes, the Advocate General's opinion, which often guides the court, made a similar point. He noted these services seem to have their own character and to be identifiable, even when provided together. And he also stressed that the internal payment structure shouldn't dictate the VAT outcome, because that would let the group essentially choose its own VAT treatment. It always comes back to objective economic reality.
Okay, the moment of truth then. The court has deliberated, considered the law, the facts, the arguments. Their answer to that first big question has massive implications, not just for Högkullen, but potentially for every corporate group in the EU managing its subsidiaries. What did the ECJ actually rule?
Okay, here it is. The ECJ ruled definitively that Articles 72 and 80 of the VAT Directive must be interpreted as precluding the services provided by a parent company to its subsidiaries in the context of active management from being, in all situations, regarded by the tax authority as constituting a single supply, which precludes the open market value of those services from being determined using the comparison method laid down in the first paragraph of Article 72.
Right, that's quite a mouthful, but the core message seems really clear. It precludes tax authorities from always treating it as a single supply where you can't use market comparison.
Exactly. It's a fundamental check on the tax authority's approach.
So connecting this to the bigger picture, what does this actually force tax authorities to do now? How does it change their job?
Well, it means they absolutely cannot just use a broad brush approach anymore. They're explicitly stopped, precluded, from just assuming that because it's a parent managing subsidiaries, it must be one single incomparable service. That whole line of reasoning is out as a default.
Okay.
This directly contradicts the Swedish tax authority's initial stance and forces them and all other EU tax authorities into a much more granular, fact-specific analysis. The court is sending a clear signal. The default assumption is not single supply, not incomparable.
So the burden of proof shifts.
Massively. The presumption now leans towards distinct services, or at least towards the possibility of using the market comparison method, Article 72, Paragraph 1. Unless the tax authority can come up with really compelling objective evidence based on the specific facts that these particular services genuinely form an objectively indivisible economic supply, they can't just jump to the full cost method in Paragraph 2. It puts a much higher bar for them to clear.
Interesting. And what about that second question, the one about including all costs, even shareholder costs, in the taxable amount if it was deemed a single supply? Did the ECJ rule on that?
Nope. The ECJ said there was no need to answer the second question.
Why not?
Because the second question was entirely dependent on the first one being answered yes. It was based on the premise that these services always constituted a single supply, since the court forcefully rejected that premise with its answer to question 1.
The second question became irrelevant.
Exactly. It was moot. The court effectively said, since you can't always treat it as a single supply, the question of what full cost means in that specific scenario doesn't need answering anymore.
Which itself sends quite a strong message, doesn't it?
It really does. It underlines the court's pushback against overly broad interpretations by tax authorities regarding intra-group services. It champions a more detailed, nuanced look at the economic reality of each service, rather than relying on blanket assumptions based just on the relationship, or resorting too quickly to that potentially punitive total cost method. It's a clear nudge towards finer detail over broad strokes.
Okay, so let's unpack the fallout.
Mm.
What does this ruling mean practically for you listening, for multinational groups, for the whole tax landscape across Europe? This isn't just about Högkullen, it's got to have ripple effects.
Huge ripple effects. For
Yeah.
tax authorities, it definitely clips their wings a bit. It significantly limits their power to just slap on higher VAT charges based purely on the fact that companies are related within a group.
They can't just assume a single supply, therefore full cost.
Precisely. That automatic pathway is blocked. They now have to properly assess each service, or at least build a much stronger evidence-based case rooted in ECJ case law for why a particular bundle of services truly forms a single economic supply. They can't just say active management single supply anymore.
Which means more work for them.
Undoubtedly. More diligence, more detailed analysis, probably needing more specialized expertise, maybe even borrowing from transfer pricing methodologies to justify their VAP assessments, and likely more potential for disputes if the reasoning isn't rock solid. Audits could get more complex, potentially longer.
Okay, that's the tax authority side. What about the companies, the multinationals, the groups with parent companies actively managing subsidiaries? How does this change life for them?
Well, for them, it's generally good news. It provides much-needed clarity and arguably a fairer playing field for VAT on these internal services, especially active management. It strongly reinforces that the primary method, the gold standard, should be market comparison whenever feasible.
Giving them more grounds to argue against the full cost method.
Exactly. They now have stronger footing to push back if a tax authority tries to impose a full cost valuation that includes, those unrelated shareholder costs. It should lead to a more accurate VAT assessment that reflects the actual services exchanged.
Does it mean companies need to change how they do things internally?
I think it probably will. It's likely to trigger a reevaluation of how groups structure and document their intergroup service agreements. There'll be a much bigger emphasis on clearly defining and delineating distinct services.
So breaking down those big management fee charges.
Potentially, yes. Instead of one lump sum for management overhead, a shared service center providing, say, IT, HR, and accounting might need to very clearly itemize these in contracts and invoices, showing their distinct services, perhaps even benchmarking them individually. Aligning documentation with the ECJ's focus on distinctness will be key for compliance.
And which sectors are most affected?
Well, obviously real estate management like Högkullen, but also financial services, definitely. Tech companies with global shared services, manufacturing groups with central R&D or supply chain management, really any industry with complex group structures where parents provide services to subs.
So pretty widespread.
Very widespread. Think about a global pharma company. Parent does R&D, provides regulatory support, marketing strategy to subsidiaries worldwide. This ruling says you can't just bundle all that as management. Each part might need its own VAT assessment based on market value if possible. It could even affect M&A deals, scrutinizing how solid the target's internal VAT setup is.
So fundamentally, this ruling is pushing for what? More realism.
I think so. It reinforces that businesses should aim for true market value in their transactions, even internal ones. It's a nudge towards greater economic realism in tax. It forces everyone, companies and tax authorities, to think more critically about how services are bundled, priced, and why those distinctions really matter for tax compliance and ultimately the bottom line across the EU. It's almost like forcing internal units to act more like independent market players for VAT purposes.
Which definitely raises some interesting questions. Could this mean tax authorities start doing much more detailed, granular audits of these internal services, demanding documentation for every little thing?
It's possible. They might feel they have to justify not using the market comparison method.
And will companies need to get much more sophisticated in describing and documenting everything, not just for transfer pricing, but specifically for VAT, to prove services are distinct?
Very likely. The burden might shift towards companies needing robust documentation to support market comparisons or the distinct nature of services.
And could that actually create challenges for companies trying to simplify their internal accounting if the tax rules demand ever more complex breakdowns?
That's a definite tension. Efficiency versus increasingly granular compliance demands. It's a fascinating shift, and it'll probably need more sophisticated systems and expert legal or tax advice within companies.
Okay, so as we wrap up this deep dive into Högkullen, it's crystal clear, isn't it? This seemingly abstract world of VAT, it has incredibly real, practical consequences for how businesses are run, how they're structured, and how governments collect revenue right across Europe.
Absolutely.
And the ECJ's decision here, it's a pretty significant marker, a win, arguably, for companies managing subsidiaries, firmly stating that tax authorities can't just default to assuming these services are one big, incomparable lump for VAT. The presumption, the starting point, has shifted.
It really has. The default is now distinct services, or at least the potential for market comparison, unless the tax authority can prove otherwise, objectively.
Which leads us to a final thought, perhaps something for you to mull over. In today's world, with global businesses designed for integration, synergy, efficiency, how do we strike that balance? The balance between the tax authority's legitimate need to stop evasion and the company's need to structure itself effectively without facing artificial tax hurdles just because it's operating internally.
That's the million-euro question, isn't it?
What does fair competition even mean when, in essence, a parent company is managing, supporting, maybe even competing with its own subsidiaries within a closed system? It really makes you think about value creation inside these huge, complex enterprises and, well, how exactly that value should fairly be taxed.
It's a fundamental tension between corporate reality and tax principles.
Indeed. So we encourage you to think about how this ruling might touch companies you interact with, maybe even the hidden tax complexities behind everyday services. Tax law, often overlooked, maybe seen as a bit dry.
It's anything but.
It's constantly evolving, constantly shaping the bedrock of our economy. What other hidden layers of corporate finance and tax are out there waiting to be unpacked? Definitely food for thought.